Most investors think their first multifamily deal is just a starting point, something to get through, something they can improve on later. But with CMHC multifamily investing, that assumption can quietly cost you a decade of growth. In this video, I want to explain why your first CMHC deal often sets the ceiling for the next 5 deals you'll be able to do. Because deal number 1 doesn't just produce returns, it shapes your entire portfolio trajectory. If you're new here, I'm Darren from DK Wealth and Growth. And if you've been following along over the past few weeks, you've seen how we evaluate CMHC-eligible multifamily opportunities, from filtering deals to analyzing pro formas and understanding why disciplined advisors reject most opportunities. Today is the long-term payoff of all that thinking. Your first multifamily deal creates the equity foundation for everything that follows. As the property stabilizes and the income grows, that equity becomes the source of capital for your next investment. That's how most multifamily portfolios actually scale. Deal number 1 funds deal number 2, deal number 2 helps fund deal number 3, and so on. But if the first deal is poorly structured, that equity growth slows dramatically. The next factor is net operating income, or NOI. NOI isn't just a measure of profitability. It's a key number lenders evaluate when considering future financing. A strong NOI profile improves your borrowing capacity. A weak one quietly limits it. So the income performance of deal number 1 influences the financing available for deal number 2. Then there's debt service coverage ratio, DSCR. Lenders look closely at how comfortably your property income supports its debt. If your first property has a strong DSCR profile, it builds credibility with lenders. If the margins are thin, future financing becomes harder, and that can slow portfolio growth significantly. Imagine 2 investors starting with the same capital. Investor A closes a carefully structured CMHC deal. Investor B closes a deal that looked good on paper but had fragile assumptions. 5 years later, the difference can be dramatic. Investor A has strong equity growth, solid lending history, and capacity for additional projects. Investor B is still managing a deal that never created the financial momentum expected. The starting point was the same, but the structure of deal number 1 changed the outcome. This is why the filtering process we've talked about over the past few weeks matters so much. The goal isn't just to protect investors from a bad deal today. It's to build the foundation that allows a portfolio to grow over time. Because in multifamily investing, your first deal is not just the beginning. It's the platform everything else is built on. When deal number 1 is structured properly, every deal that follows becomes easier. Equity grows faster. Lending relationships strengthen. Opportunities expand. That's the compounding effect disciplined investors are really aiming for. If this kind of long-term thinking around multifamily investing resonates with you, make sure you subscribe to the channel. Every week I break down how serious investors evaluate CMHC-eligible opportunities and how disciplined portfolios actually grow. And if you'd like to explore the multifamily projects that pass the filters we talk about here, you'll find links below where you can join the investor list or learn more. Thanks for watching, and I'll see you in the next video.